All right, fellow traders, welcome to my channel, and my name is Lawrence. And today I will be talking about break of structure and change of character. This is one of the very technical thing that you need to know as a trader. And if you're new to trading, I've tried to make this as simple as it is so that you can understand the concept of it. And if you're not new to trading, you also need to have this reminder in your mind to know how this works. So we're going to be checking break of structure and change of character. So the thing we're going to go through is the introduction part. I'm going to introduce what break of structure and CHoCH actually is, and we're going to check the understanding of break of structure in itself, and we're also going to check the key features of break of structures, and I will show you the practical examples of break of structure in price actions, also how to use break of structure in trading. Then we move further to change of character, or CHoCH like most trader calls it, and we're going to check the key features of CHoCH as well. Also, we check the examples of CHoCH in price actions and how to use CHoCH in trading as well. Then furthermore, we're going to jump into combining both break of structure and CHoCH for smart money trading. Also the practical applications and trade executions as well. And the entry strategy here is what I would love you guys to focus more, because according to my years of experience in trading, I've realized the best strategy for entry when it comes to break of structure and CHoCH strategy in trading. So we're going to check for the trend continuation, which is base of break of structure based trade, and also for trend reversal, which is CHoCH based trade. And finally, we're going to check about the stop loss and risk management and indicators that you could use to enhance the break of structure and change of characters analysis. And lastly, we're going to check the common mistakes that most traders made and how to avoid them. All right, so introduction, guys. So in Forex trading, the break of structure is something that is very, very powerful, and also change of character. They're very powerful technical analysis approach that you should use to identify the trend reverser and continuation pattern. So this strategy is deeply rooted in price actions and market structure, making it highly valuable for day traders and intra traders. So another thing is that by integrating smart money concept, SMC, traders can enhance their ability to recognize market shift, anticipate price movement, and refine their entry and exit point. So this is quite important for you as a trader. You need to know when the market is about to shift to the other side, so you know when to get out of the market or when to continue and leave your profit to continue running. If you don't know about the break of structure and change of characters, you'll be a little bit scared of, oh, when the market is moving. Even market might just be on a downtrend and also gonna reverse in a very short while. But if you realize what this concept is, it will give you more confidence to stay in the market. So this guide will break down the core principle and the practical applications and the advanced techniques of breakup structures and strategy for you. Next thing we're going to check is understanding breakup structure itself. So breakup structure occurs when the price breaches a significant support and resistance level. So in this case, it's going to signal a trend continuation. So it looks something like this. So we have the market is on uptrend. It creates a resistance level right here. It comes back down here, and there's a demand that pushes the price up in this place. So that is when the price touches demand again and rally back up again. So as a rally back up, it's higher than the previous high. So that is how we create a break of structure there. So now you can clearly see that the break of structure is a continuation market. So it's on this way up. And other thing is that this break of structure is a confirmation that the prevailing trend remains intact and that traders should align their strategy accordingly. So we can clearly see that the market is on its way up. So when there's a pullback here, you don't need to be afraid, because you know that this is just a pullback and the rest is still going up. So you can place your stop loss as higher as you can, since you understand what the break of structure does in the market. So let's see the key features of break of structure. So it occurs in a trending market. So it can either be bullish or bearish. So if it's a bullish market, we can see we form a higher high, and this one is a reversal, and most traders call it pullback, right? So it continues again, it gives us another break of structure, it breaks the previous high, it gives us another higher high, continuation like that, it continues like that. And if it's on a bearish market, we form a lower low, then there is a pullback, which means traders are taking their profits, or they are buying into that. When they realize that it's slowing down, they buy into it and get out again, buy into it and get out again. So it continues going down again. So we can clearly see the break of structure on the bearish down trend as well. So another thing is that it also breaks a key swing high uptrend or swing low downtrend. So here, as exactly as the same as I've just showed you earlier, the price swings high, comes back, the same thing, does the same thing, keep going. This is on a trending market, which is on a continuation on uptrend market. If it's on the downside market as well, it does the same. It's always going to be the same. So you can clearly see what the market is doing. So also, it confirms trend continuation. So when price respects the new supports and resistance, so we can see that this is a demand here. This is a support right here. So it rallies up, it comes down, another support, it creates another support, then it rallies up again. This is a resistance right here, but it breaks that resistance and continues and come back at the pullback and go again. It breaks that resistance again, it continue going. So that's an uptrend. So you can clearly see on the price chart. And if it's on the downside as well, on the resistance, it keeps breaking the support, it keeps breaking the support and creating another support, breaks the support again, creating another support. As you can see, it doesn't break the resistance because it's on a downtrend market. But if it's on the uptrend market, like I've showed you earlier, it breaks the resistance. So let's move on. So we're going to check the examples of break of structure in the price action. So here is a chart pattern of USD and JPY on a 1 hour chart. So we can clearly see that the price is an uptrend right here. We keep seeing the higher high being formed and the higher low, and again a higher high, higher low. So this signify an uptrend market. So let's say you place your order somewhere around here. Since you already know that it's forming a new higher high and this is just a pullback, that will give you more confidence to wait and let your trade get to your TP. And here it creates an higher high and higher low by also breaking a previous resistant level. So a new higher high is obviously a resistant level, because once price get there, a lot of traders are getting out of the market, taking their profits. So it forms a resistance right there. So once people take their profits, price comes down. Then again, it rally up again and break the previous resistance and create another higher high. So it continue like that, it continue like that. So we can clearly see that this is an uptrend market. So it's favoring the buyers to continue and wait for them to get to their TP. So if it's a downtrend market, we can clearly see that the market is coming down right here. We have a lower low and a lower high, and the same keep coming down, keep coming down, keep coming down, which means when the pullback happens, people pick their profit. And this candle right here, it could be a major news red day that day, and still it doesn't breaks the previous lower high, then the price falls back down again. So this is one thing about understanding break of structure. It gives you that clarity of mind. Like, you have to wait and see, because you can clearly see that the market is on the downtrend and it continues breaking the support level as well. So the lower low is a support level, Another lower low is another support level. Then it breaks that. It keeps coming down, keeps coming down. It gives you clarity of mind that you should leave the market to continue doing its thing. So this is what we've checked so far. We've checked a bullish break of structure, which price creates a higher high and a higher low, and also breaking the previous resistance. So we've checked that. That is out of the way, and I'm sure that you've understand how that works. So we also checked the bearish break of structure as well, and we've checked that. We've get that out of the way. Let's see how to use break of structure in trading. So you need to identify a clear market trend. You need to know if the market is bullish or bearish. I've teach you how to look at that, and I'm sure you can actually identify that when you see a price chart on your own. Also, you need to wait for a confirmed break of structural level on a higher time frame, either on the 1 hour time frame or a 4 hours time frame or a daily time frame. So the next thing you need to do is to look for the entry confirmation, so you can understand the candlestick pattern. There's so many candlestick patterns that could signal that itself. And you can also check the volume of the market. If there is a lot of orders in the market, and you can tell that the price is about to break that structure, because the volume will tells you that people is already in the market. And you can also look for the indicators that confirms that, so before taking a trade. So now let's move on to understanding change of characters. So change of character is an early signal of a potential trend reversal, which means, as we can see right here, we see the prices on a downtrend right here. It's on the downtrend. Then the price pull back, comes down, it breaks the previous lower low. Then from here, there's a clear demand that pushes the price up and breaks the previous lower high. So once that previous lower high is been broken, that is clearly a change of character. So you can clearly see from there that, oh, the price is not following the initial trend. It has changed right now. So the supply there, which is on the lower high, is already broken, and the demand here is being respected. When the price pull back to that demand, then it continues. So this is how to identify a change of character. It's obviously a trend reversal. So as you can see, it continues and we break the previous higher high, then the market continues as well. So it highlights a shift in the market sentiment. So which means buyers or seller start gaining control. So it could happen in an uptrend market or in a downtrend market. So unlike break of structure, which confirm trend continuation, change of characters signals a potential shift in direction. So once you identify this, you know when to get out of the market, or if you still need to stay on the market. But it's obviously the time to tell you that, oh, something is about to happen, so I need to get out of the market or take my profits, or set my trade in a break even. So the next thing we're going to check is the key features of change of characters. So change of characters indicate trend weakness or a potential reversal. So it could be a bullish trend or in a bearish trend. So if it looks like this, in a bullish trend, we can see higher high, higher low, higher high, higher low. It touches the new higher high right here. It comes down to high, it forms another higher low, right? Then it continues, it forms another higher high, but from there, they pull back, breaks the higher low, breaks the previous higher low. So that's how you can identify a change of character here. So this is from a bullish to a bearish change of character. So if it's on the other side as well, from bearish to bullish, the same thing keep happening. Lower low, lower high, lower low, lower high, then forms a new lower low and forms another lower high. Then it breaks the initial lower low, then it pulls back. So the demand here is very strong. So that's why it breaks the initial lower high and form a new higher high. So from there we can clearly see that this is a change of character. So it's from a bearish market to a bullish market. So another thing is it occurs when the price breaks a recent structural high or low. So which means opposite of the exiting trend. The same thing like I just showed you, it continue repeating itself. You can clearly see it is as glaring as it is. So another thing is that it often found a key supply and demand zones. You see, so the thing is this: when change of character happens on the higher time frame, there might be a previous demand that is waiting right here. So that demand means a lot of people already placed their trade in this place. So if there's a lot of buyers in the market, definitely it will change the character of the trend of the market. So there is a higher time frame demand right here, which will pull back. You see, it could push back, and there's a demand here that pushes the price more than the previous one, so it forms another demand and push back up again. So you see, when it goes to this higher time frame supply zone as well, which means there's a lot of people that already placed their trade that they're willing to sell from this place. So once everybody gets into the market at that particular point, it could be in a London section, it could be in a New York section, sometimes it's even in Asian section. So it pushes back, it changes the character of the trend, then becomes a downtrend market. So we're going to check about the examples of change of characters in the price action. So this is an example of a chart pattern of USD and JPY on a 30-minute time frame. So clearly we can see that the price is on a downtrend. It keeps forming, it keep coming, it keep coming, it keep coming down, forming a new lower low and lower high and lower low. So however, there is an initial daily demand right here. You can clearly see that on the price chart, which means a lot of people are willing to buy the market from here. So as you can see that we have a daily demand zone here, which means price tends to reverse from here. So as a trader, you must have understand that this is where you need to place your trade and go long. So now you can see the price breaks that. It keep consolidating. Actually the price keep consolidating, buyers are buying, sellers are selling, but the sellers couldn't push the market downward. So which means buyers already took control in the markets. Then once the rally happens, it breaks the initial lower high. So that's a clear change of character right there. Then it moves us, then it changes the direction. So we can clearly see that the market has changed direction right there, which means a buyer's already stepped in at this particular place and pushes the price back up. So on the other hand, we have a clear uptrend market right here. So and it gets to the daily supply zone, which means a lot of people already placed their trade here to sell. They place their sell trade here, and prices tend to reverse from here. As you can see, the suppliers here pushes the price to a new lower low, and it changed the character of the trend of the market. It changed it to a downtrend. So here we have a pullback right here. So this is another thing that gives you the confidence in the market that this is just a pullback because suppliers already take control of the market from here. So this is just a pullback. You can just wait for your trade to have a pullback and continue rally down again. So that is what change of characters and break of structure gives you. It gives you that clarity of mindset. So it means it's signaling sellers are stepping, and the rest sellers already stepped in the market, and the price has changed the direction. This is what we've learned so far. We've checked an example of treasure in a price action. We check a bullish treasure, which we know that the price is downtrend, and it because it was making lower high and lower low, then it breaks above a previous lower high. So which means buyers has already stepped in there. So we've checked that, and we also checked the bearish CHoCH, which is the price was making higher highs and higher lows. So this is an uptrend market, then breaking up below a previous higher low. So which know that the sellers already stepped in. So now let's check how to use CHoCH in trading. So the first thing you need to do is you wait for a confirmation of trend weakness. You can tell that it's forming a weakness, and by doing that you can see a failed break of structure, which means it's no longer continue the trend anymore. It could either be a bullish market or in a bearish market. You can notify that, oh, this has already broken the break of structure, so there's a weakness in the market, so the market's about to change the character. So also we can check the candlestick rejection, and you can also check the diverging. So once you realize all those things, this will give you confirmation that, oh, this trend is weakening. And you can also combine CHoCH with liquidity zone. And below support, there is always a stop loss. Most traders will place their stop loss below support, and that's where you could tell that there is a liquidity in the market. There's money in the market to be picked in right there. And above the resistance as well, there is always a stop loss there, and those things are called liquidity. So this is where you can notify your liquidity zone and know that something is about to happen there. Or you can check your other blocks. Other blocks is where buyers are already stepped in. You can see that the price has already accumulated in that part, so which means it could come back again and touch the other block for either a demand or a supply market. So the third thing is you can look for smart money confirmation. So it can either be a wyckoff or accumulation or distribution pattern, and fair value gap as well. So these are the things that you can put in mind in order for you to use CHoCH in your trading smartly. So now let's say we're combining both break of structure and CHoCH together. So by combining both break of structure and CHoCH, you can pinpoint high probability trade setup. You can know that something is about to happen right there. So combining both together will gives you confidence to enter that market, either in a bullish market or in a bearish market. So you can also identify whether to continue with the trend. So once you notify your break of structure is happening and you can see that the demand is pushing higher, you can stay there. You know that this is happening, or you prepare for a reversal, which is a CHoCH. So also combining both together will also reduce false breakouts. So by aligning break of structure and CHoCH with key support and resistance zone, you can tell what's about to happen. So the next thing is you can improve trade timing by using additional confluence. It can either be your Fibonacci to know where the price is. Maybe the price is on a discount level or it's on a premium level. You can use your Fibonacci to identify that. You can use your RSI diverging to tell maybe something is about to happen, so you can get notified with those things. And your order flow analysis as well. All these things can give you confidence in the market. All right, so that's how you can combine break of structure and CHoCH together to give you a very, very high probability trade setup. All right, we're going to check the practical application and trade execution. So for entry strategy, which is on break of structure based trade, we can definitely tell break of structure is nothing but a continuation market. So we're going to identify a strong break of structure in a trending market. You can tell what the market is doing by looking at the chart. You can see if the market is an uptrend, which is trending, or a downtrend, which is also trending. So it can either be bullish market or bearish market. So we're going to look for a pullback to a demand and supply zone, or your order block. So order block is always in a demand zone or in a supply zone. So which means the last candle before a large impulse in the market is your order block. So we're going to enter with confirmation. So example of the things we're going to look for is bullish engulfing candle pattern, or you check your pin bars candle pattern, or you look at your trend line retest. So if market is on uptrend, there is always going to be a point that the market continue touching and continue moving upper like that. If it's on a downtrend as well, market is going to continue touching a particular supply zone and keep falling downwards. So these are the things that you need to have in the back of your mind if you want to get into a trending market by using break of structure. So for entry strategy for a reversal pattern in the market, so which is CHoCH. So we're going to check for a strong CHoCH, all right, which is at the key market structural level. So you can tell like this is no longer continuing again. There's a change in the market already, and that change has already broken the initial lower high. Then you can tell that, oh, something is about to happen. Then you base your trading strategy at that particular point. So we're going to wait for a liquidity grab, which is a stop loss wick. We can see the wick that is already driven up and come back, and it doesn't close with a body candle, it only closes with a wick. So that is liquidity grab, and we're going to check for the false breakouts as well. So right after that, we enter once the price confirms rejection and form a reversal pattern. So you already know when exactly the market is going to do some certain things. Then you enter once and place your stop loss. All right, we'll move to stop loss and risk management. So how to place your stop loss. So let's say you're going for buys. So you should always place your stop loss below your swing lows. And if you're going for sell, you place your stop loss above the swing high. So it looks something like this. We can clearly see this market is an uptrend until it got to this particular place, and the supply was very, very strong, which broke the structure and it changed the character of the market. So let's say here is a demand zone, and let's say you get in at this demand zone. So you place your stop loss below this swing low, and you put your take profit at this swing high right there, because you can tell the market is uptrend, right? So you can place your take profit above this swing high or at this particular place. But if you're anticipating for a longer movement in the market, so you can still put your take profit in a upper trend like that, but just make sure you place your stop loss below the swing low for buys. So risk to reward ratio, aim for at least 1 to 2 or 1 to 3 for optimal returns. So this is an example of risk to reward. So here we have our take profit here, and we have our stop loss here. So this is ratio 1 to 1. So which means you're risking the same amount and gaining the same amount. That is not ideal. So let's say you're risking $1,000 on the trade and you're targeting $1,000 profit. That is not ideal. But the best one is 1 to 3 ratio. So let's say here we are risking $1,000 here and we are making $3,000 profit. So this take profit is huge, and this is what you need to anticipate as a trader if you want to make consistent profit in the market. And your stop loss should be this small while your take profit is this high. So here is not ideal. Please don't go for this if you want to make money in the market. So this is preferable, and this is also preferable. So trade management, move stop loss to break even once the price reaches ratio 1 to 1. So let's say we're like this. Yeah, we enter the market when the support level breaks, right? This is support line, and you enter the market right there, and your market's already moving in profit, and your stop loss is above the support level. So the next thing you need to do is move your stop loss to the entry. So which means you're protecting your trade. You know the market is going somewhere. You already anticipate where the market is going, right? So you protect your trade by leaving it to continue going. And if the market pull back and touches your stop loss, so you don't lose anything. So you get out of the market at zero cost and zero profit. That's how to manage your risk when trading. So indicators to enhance break of structure and CHoCH analysis. So you can look for a volume profile. You can notice what the market is doing at that particular point. There's a lot of orders in the market, so that shows that something is happening, and you could wait for the buyers to push the market to where you're going, either in a bullish or in a trendy market. There's always a volume to project that. And also you can check your Fibonacci level, so identify retracement and entry point. So let's say the market is moving downward, right? You draw your Fibonacci to know where the market is about to reverse. Then that will give you more clarity. So volume profile and Fibonacci level. And the next thing is your RSI or your MACD. These ones detect the movement shift. And the next is other flow tools that analyzes liquidity imbalance. So by combining these four indicators together, it will give you a lot of confidence either to stay in the market or to get out of the market, because this indicator tells you something significant, right? So that's what you need to pay attention and notice. So common mistakes and how to avoid them. So mistake number one, some traders misinterpret break of structure and CHoCH. So instead of you not to make that same mistake, always use multiple time frame to confirm, right? For your confirmation. Mistake number two, entering too early. This is also a very big mistake that most trader does. Instead of you not to fall in that same trap, wait for a solid breakout with volume confirmation. Once the volume is high, you can tell that people are already in the market, and wait for exactly that to give you confidence in the market. And mistake number three, ignoring liquidity zone. Break of structure and CHoCH work best with support and resistance, fair value gap, and institutional order flow. Institutional order flow is when you see a huge gap in the market. Retail traders doesn't move the market that much. We're only capturing what the market does. Institutional buyers are the one that actually move the market. So the mistake number three is ignoring liquidity zone. Don't ever ignore that. You need to pinpoint it to know exactly what the market is going to do, and you follow the order flow of the market. So mistake number four, poor risk management. Once you set your trade, don't just leave your trade like that and let it happen. Even if you are sure of what the market is happening, you always need to set your stop loss and use proper position size. Instead of you not to get liquidated in your market, you need to set exactly what you're willing to risk and how much your profit is going to happen. Let's have a recap of everything we've learned so far. And these are important details I want you to keep in your mind. The break of structure and CHoCH strategy is a very, very, very good thing. It's a game changer for traders. So if you're looking for a refined technical analysis and trade execution, study your break of structure and CHoCH very well. So when you master these concepts, it's easier for you to gain edge in the market. So your smart money principle, your market structure or liquidity analysis, all this will be easier for you to pinpoint once you understand break of structure and CHoCH strategy. So key takeaway in this crash course is, remember that break of structure confirm trend continuation, while CHoCH signal trend reversal. So you should use higher time frame to validate breakouts and avoid false signals. And you should also combine your liquidity zone, your Fibonacci level, and volume indicators for precise precisions, right? So those are the things we give you hedge in the market. Maintain strict risk management to ensure consistent profitability. So make sure that you know what you're risking. If you're risking 1% today in the trade, don't risk 10% tomorrow. You might lose what you gain for the next trade. So make sure you have a strict risk management. Always risk 1 to 2% of your balance, and you gain times 3 of it. So by leveraging this insight, everything I've taught you so far, it will help you to enhance your trading strategy, all right, and improve decision making in a volatile market conditions. So that's it, guys. I know you've captured a lot of things in this crash course. You've understand what break of structure is and CHoCh is itself. So there we go, guys, and I'm sure that you understand some basic principle of break of structure and CHoCh in this crash course, and I'm glad that you stay up to the end to understand what all of this is all about. So this is my social media. You can catch me up here for one-on-one chats. If you want to have a quick chat with me, I'll be available on this social media. Thank you guys, and stay tuned for another crash course coming shortly.